Before we begin, it's my pleasure to introduce our speaker for today, Chin Yixuan. With a background in economics from University of Malaya, currently Yixuan is the General Manager of Algopedia Sdn Bhd, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance, investment through his personal blog nomoneyla.com. Besides that, Yixuan is also featured in various media platforms such as City Plus FM, BFM Caijing, and others. Without further ado, I'm delighted to hand over the presentation to Yixuan. Yixuan, there you go.
And today our topic is what you need to know about currency and gold futures. So if you are new or you wanted to learn a little bit about how currency and gold futures work in Malaysia, this is the webinar you need to attend. Now a quick disclaimer, this presentation is provided for general information only. It's not intended as an advice or offer or solicitation for purchase or sale of any securities, stocks, futures, or investment products. Stocks, securities, and futures imply risk and to be undertaken only if you understand the risk. Please seek your own tax, legal, and financial advice before investing in stocks and futures. All information in this presentation is subject to change without notice. Now, what are we going to talk about today? Today, we are going to talk about what you need to know about the fundamentals of the Chinese currency and some of the interesting and historical facts about Chinese currency. Other than that, we are also going to explore what's the relationship between the Malaysian ringgit and the Chinese currency. And we are also going to explore the fundamentals of gold. And finally, I'm going to share with you some of my personal ideas or approach on how to trade the Chinese currency futures and also the gold futures in 2024. Now, before that, do you know that you can now trade the mini US dollar and offshore Chinese currency, which is FCNH and gold FGLD futures through Bursa Malaysia derivatives? Now, this is very, very exciting. This is a very new product from Bursa Malaysia, which is the mini US dollar / offshore Chinese currency futures, which is FCNH. So after this sharing session, if you guys are interested to gain exposure to the Chinese currency, this is certainly one of the best way to go, because through the futures market, you can is highly regulated and you can perform your trading, be it to the upside or downside. In short, you can go long or short for in this through FCNH. Now, aside from that, you can also trade gold futures in Malaysia through FGLD. So this is also a fairly new product that was released last year, where you can gain exposure of gold because it tracks the international gold price and is regulated by Securities Commission and is denominated in US dollar and settled in Malaysia ringgit. Now, why trade FGLD? A quick one, because you can trade gold in both directions, be it long or short, and you can hedge against the downside risk in the physical market, especially if you own gold as an investor. And also, you through the futures market, you get access to leverage, which means you need a lower capital requirement to trade gold, which is a fantastic thing. Now, with that in mind, let's start. Let's go straight ahead into what our main discussion today. Now, to understand one of the key currency, the currency that we are going to talk about today is the Chinese currency. And to understand Chinese currency, I think it's very important for me to lay the context. So allow me to share with you 4 very interesting and important facts about the Chinese currency that you need to know. Now, do you know, by the way, that the Chinese currency exists in 2 forms? Number one is the offshore Chinese yuan, which in short we call it CNH. CNH is basically used outside of mainland China, such as Hong Kong and the global financial market. And why? Because it is freely convertible, which means that it can be used for international trade and financial activities. Now, another one might be a little bit more familiar for most people, which is a Chinese yuan. It is basically, or in short, CNY. It's basically used for transaction within mainland China. Now, when it comes to price movement, generally speaking, CNH and CNY tend to move in tandem with each other, as you can see in the chart on your right. So basically, they move together in short. So in general movement, they tend to be the same. So this is one of the many interesting facts that most people may not know. Now, another very interesting fact is, unlike the US dollar, right, which the value is determined by the market forces, the Chinese currency is actually what we call a managed float currency. Now, what do I mean by that? Managed float currency, right, essentially means that the extent of how the Chinese currency move is partially managed by the Chinese authority. Now, and how do they do that? If you may ask, right? This is done through a mechanism called a yuan midpoint fixing, where the midpoint every day the Chinese authority will get a reference from multiple some of their financial institutions, and they set a midpoint to decide how much is the Chinese currency against the US dollar. So as such, right, after you set the midpoint, the dollar renminbi is allowed to trade 2% on either side, to the upside or to the downside from the midpoint every day. So this, because the Chinese currency is a managed float currency, this allows, right, the Chinese central bank to step in whenever they think that the Chinese currency is too strong or too weak. So as you can see in the screenshot, last year, in August last year, 2023, when the Chinese currency was weakening too much against the US dollar, the China central bank actually step up with to intervene against this weakening situation. So how does it work in exact? Let me show you a quick graph over here. This is what happened. So this graph, right, basically shows you the difference between the midpoint set by the Chinese authority versus the expectation or forecast by the financial institutions, right? So as you can see, it has been very, very stable until, if you can see on the very far right, is during the August of 2023, where the Chinese authority actually set the midpoint, which is very different from the expectation of the market. So you can see from this chart, where the Chinese authority can actually step in to intervene or make adjustment whenever they feel like things starting to not to go out of control, be it the currency strengthening too much or weakening too much. So this is some of the very interesting fact as well. So interesting fact number 3 is, do you know that in 2015, the Chinese currency actually underwent like one big devaluation exercise? Yeah. So in 2015, Chinese authority actually decided to devalue their currency after a decade of economic growth in the in 2000s. Why? Because they feel like after a decade of economic growth, right, the currency has grown strong. So they feel like an appreciation in the Chinese currency will reduce the competitiveness of China's export, which could potentially lead to lower growth and problems like increasing unemployment. So what you need to know, essentially, ladies and gentlemen, is this devaluation exercise, the impact is very big. For one, because things become cheaper after devaluation in China, there's an increased competitiveness of Chinese goods among when you compare it to global products. And as such, right, this will lead to strengthening in the China's manufacturing sector. And relative to the Chinese currency, because China devalued their currency, in relative, US dollar became stronger. So what happened is it increased the purchasing power of the US consumers towards Chinese goods. So it led to an increase in import spending from the US. Now, it also means that because US product became more expensive to the Chinese people, right, there will be a drop in US exports. Now, this is quite interesting because it leads to another very important incident in, I would say, a milestone in the Chinese currency. In 2016, the Chinese currency was given the status of reserve currency by the International Monetary Fund, which is the IMF. Now, because of the devaluation exercise, because it was intended by China to make their currency more market orientated, to be included into IMF special drawing rights, which is SDR, basket of reserve currency, alongside major currencies like the US dollar, the euro, the yen, and the pound. Now, what is an SDR? If you may ask, some of you might ask, right? SDR is essentially an international reserve asset, right, that allows IMF members to purchase domestic currency in foreign exchange market to maintain their exchange rate. So IMF re-evaluate their currency composition every 5 years. But what you need to know, actually, the most important thing is the impact of China currency given the reserve currency status. Number one is the China currency is recognized by the as a stable store of wealth by the financial world. And number two, since the rate of borrowing from IMF depends on the interest rate of the SDR, which is the basket of currencies, the cost of borrowing would be influenced partly on China's interest rates. Now, understanding the history, now that we understand the history of the Chinese currency, right, we come to another very important discussion. Is there a correlation between Malaysia ringgit and the Chinese currency? Now, let's take a moment and take a guess, right, of ladies and gentlemen who's listening today. Okay, number one, do you think that the Malaysia ringgit and the Chinese currency is positively correlated, meaning when the Chinese currency go up, Malaysia ringgit go up? Or number two, do you think that the Malaysia currency, our Malaysia ringgit, and the Chinese currency is negatively correlated, meaning when the Chinese currency goes down, Malaysia ringgit goes down? Which one do you think? One or two? Comment leave your comment in the comment section, right? Let me know what you think. Okay, I think some of you mentioned positively correlated. Thank you. So the answer is it depends on when you look at the situation. So remember that I mentioned the Chinese currency was actually given the status of reserve currency in 2016. So what you are seeing is, on this chart, what you are seeing is basically the blue line represents the US dollar and Malaysia ringgit. The red line represents US dollar and the Chinese currency. So essentially, what it tells you from comparing this chart visually, right, is you can look at the correlation on a visual perspective. Now I want to divert your attention. Oh yeah, before that, how do we measure correlation? So if you look at this chart over here, you see like a small letter R. This is the sign of correlation. So if the correlation is nearer to 1, the higher it is to 1, the closer it is to 1, means the stronger the positive correlation between two elements. If it's closer to -1, this means that there are stronger negative correlation between two elements. Okay, now what you're seeing right here, I want to divert your attention to before 2016. Now, before 2016, on your left, right, if you look at the chart, before 2016, the Chinese currency, when relative to Malaysia ringgit, was actually in a mild negative correlation. This means, right, they have very little relationship or very weak negative correlation. But if you look at the first circle on the left, after 2016, when the China is recognized as a reserve currency, if you scan through each chart by the timeline as it goes, right, you will start to notice that our Malaysia ringgit's correlation with the Chinese currency becomes stronger with time. So you can see the R value becomes stronger with time, 0.79, 0.81, 0.93. So as such, right, Malaysia ringgit and yuan, or the Chinese currency, has been gaining positive correlation since the Chinese currency gained the status as reserve currency. Now, how about recently, right, 2022, 2023? Now, what happened in 2023? I will share more about it, about the situation, fundamentals of China economy later. But essentially, China economy has been facing some challenges, right? Instead of raising interest rate, they have been cutting interest rate in 2023. So what happened, right? When they cut interest rate, their currency become weaker. against the likes of the US dollar. So as such, you can see our correlation, right, in 2022, which is marked in orange and gray, and 2023, which is marked in gray, we are actually very, very high, very, very close to 1, right? Which means one of the reasons why our Malaysia ringgit drop weakened so much against the likes of Sing dollar or also the US dollar is because we are positively correlated in with the Chinese currency, which drag our Malaysia ringgit's performance. Now you know, right? Now that we understand the history and the interesting relationship between Malaysia ringgit and the Chinese currency, let's look at some of the very important fundamentals behind Chinese currency, especially for 2023. Now, the Chinese currency has weakened against US dollar in 2023. If you look at the chart, this is a US dollar Chinese currency chart. US dollar has been in the uptrend against the Chinese currency. What happened in 2023? Now let's look at this. Number one, this is because there have been a very different policy or in terms of interest rate decision for between China and the US in 2023. You can see in the black line, US has been raising interest rate while China has been cutting interest rate. So as I'll talk about this more in coming slides, China has been facing a difficulty in their economy especially last year. So to spur growth in the market, they actually cut interest rates so that it provides more liquidity to the market in hope that it will spur economic growth. So when this happens, right, when the interest rate difference is so big between US and China, capital, can you take a guess, if you have money, where would you want to place your money? Obviously, for most people, for most investors at least, they'll be placing money in the US dollar, which gives them a higher interest rate, right? Makes sense? Now, this is one of the reasons why there's such an interesting scene in the global market. Now, number two, China has also in 2023, actually way before 2023, there have been their property or real estate sector has been struggling, as you can see in the screenshot over here, right? Not too long ago, China, one of the largest property developer, Evergrande, has been ordered to be liquidated, right? By the institution, right? By the market. So as such, this is a very challenging sector, and because real estate sector has been a very important industry to the China economy, China economy took a hit. Now let's look at some numbers, right? Now in 2023, the new home sales for the China market actually dropped by 6%. And on the other hand, right, second home prices has been declining as well. So, and not only that, right, if you follow the news, you would know that the property developers in China, they have been defaulting, right? Since 2020 to 2023, they have been in bond default of almost close to US dollar 125 billion. So all of these factors combined actually drag the whole China economy down as well. Now, it's not just a property sector, ladies and gentlemen. The China economy has been in a very challenging state as well, especially when it comes to their export. So if you look at this chart over here, in 2023, their export has dropped for the first time in 7 years. So the last time they have a declining year in export was in 2016. If you look at the red color highlight on the left, right? So this is how challenging the economy has been for China. And not only export, right? Consumption as a whole has also been challenging for China. So retail sales, you are looking at this retail sales data in China. In 2023, retail sales rose by 7.2%. While this seems like a good thing, right? It is positive, right? But the growth is the weakest if you exclude the COVID years. Yes, it's the weakest since 1999. So as a whole, you can say that the China economy has been in a very challenging state in 2023. And all of this thing combined All of these things combined, ladies and gentlemen, this cause a deflationary risk in the China economy. Now, some of us Malaysians, we are very familiar with inflation. Things become more expensive. But in China, it's actually a very interesting scene where Malaysians would, typically Malaysians, when they see things price dropping, they say, yes, good, the price finally dropped, right? Life would be easier. But in China, it's been they have a very unique market economy condition right now. So imagine China has a weaker currency relative to the currencies like the US dollar. So with weaker currency, you imagine, right, there'll be, because China with a weaker currency, things become cheaper in China for other countries like the US, right? You would imagine that export would increase. And when export increase, company makes more money. By right, companies will pay more to employees, which means when employees make more money, right, people like us, we will spend more. And when people spend more, we will have a healthy inflation. But situation is slightly different in China because they have a lower export and consumption throughout the country. What happened is they go into a price deflation. Price falls due to weak demand, and because demand stays weak, right? People tend to not delay their spending because they are expecting price to get even cheaper. So imagine if today the price of property is dropping, but if you expect it to drop further, will you buy it today? No. So because you're expecting it to drop further, you want to get a better deal. So you defer your spending. So this is what's happening in the China economy right now. It goes into a very challenging, I would say, a death loop in the market because of this deflationary risk. Now that we understand what happened in the China economy right now, I would like to share with you some of the things that you need to consider while trading the US dollar and the Chinese currency or FCNH futures in 2024. And again, this is my own opinion, right? So there are two things that you need to be very aware of if you are a trader or investor in this market. Number one is how would the Chinese government manage their deflationary risk this year? And number two, another very important thing to note is how would US decide on their interest rate decisions in 2024? These are two key things that you need to pay attention to this year. Now, to give you a quick context, the Chinese currency has been weakening against the US dollar in 2023, and also they're also facing deflationary risk, means prices are dropping due to a weak economy fundamentals such as their export, consumption, and their property sector. Now, as such, right, you need to observe, right, this year, can a weak Chinese currency raise domestic price of imported goods to spur inflation enough to help unroot China's deflationary condition? Now, which means, right, can the high, because as a whole, China have a weakening currency, so relative to that, the US products that they import become more expensive, right? So we hope, we shall hope that this more expensive imported goods can spur some form of inflation back to China to help counter the deflationary effect. So there are a few things to consider. Number one is in order to do that, theoretically, it's very easy to engineer a weaker Chinese currency, which is simply to cut rates further, right? But what if the US begin to cut rates, their rates as well this year? This will the difference, if the US started to cut rates this year, the US and the China interest rate differential will start to shrink. This will leave the Chinese currency with the chances that it will grow stronger instead of weakening. So this is something to that the China government can do. However, the case against this, right, is if China decides to further weaken their currency, China's trading partner, people like countries like Malaysia, will be less likely to, less willing to accept Chinese currency as payment if they think that the currency will keep losing value. Also, if the currency keeps dropping, right, there will be increase in capital outflow to other places or countries that offer better interest like the US. Now, this is something that you need to pay attention to when you wanted to trade or invest in the FCNH. Now that we covered the factors or fundamentals about the Chinese currency, let's cover another side of the story, which is gold, right? In this section, I'll share with you the fundamentals and ideas to consider while you are trading gold. Now, first of all, I have two questions for you. Number one, who do you think gold is a volatile or stable asset? If you think it's a volatile asset, you can just type V in the comment section. If you think it's a stable asset, type S in the chat. Right. So some of you type V, some of you type S. So we'll find out through statistics, right, through data, and see if gold is indeed a stable asset, as most people tend to assume, right? So, okay, I'll just tell you the answer first, all right? So gold is fundamentally volatile in nature, especially when you compare to, assets like bonds and home prices. So I want to divert everyone's attention to this very interesting chart over here. This chart comprises of the real asset class returns from 1972 to 2021. There are 6 assets here: gold, S&P 500, which represents the US stock market, international stocks, US real estate investment trust, the US Treasury bond, and the US home prices. So basically what you want to know here is if the chart of a particular asset swing up and down a lot, right? There are bigger swing to the upside and the downside, means that it is a relatively volatile asset. So if you look at gold relative to US Treasury bond, which is in blue color, and also US home price, which is in brown color, you'll notice that gold is actually more volatile asset compared to the other two. And not only that, if you look at the gold, right, if you look at this visual compared to the likes of S&P 500 or the international stocks, you'll notice, ladies and gentlemen, that gold actually is not so much of difference, right, in between, at least in terms of the swing that they experience, right? So what we can say from this, from historical data, is gold is actually a fundamentally volatile in nature asset. So if in the future, whenever if your friends who are investor, or some of your parents, right, who might have some form of assumption tells you that gold is actually very stable, buy gold and so on, you should this chart today, based on historical data, shows you that it's actually not as, I would say, not as stable as most people tend to think. All right. Now, I have a second question for everyone. Now that we understand from historical data that gold is volatile. Question number 2. Do you think gold is effective protection against inflation? All right. Question number 2. Yes or no? Right. Let me know in the comment section. So the question is, do you think gold is a do you think gold is a good protection against inflation? Yes or no? All right, I'm seeing a lot of yes. Okay, now let me review based on historical data again. Let me review the answer to you guys. So gold is actually not an ideal inflation hedge. So let me show you, right? This is the years where US inflation is more than 4%, which is what we consider high inflation, right? So all these years was when US experienced inflation more than 4%. This is the performance during all those years, right? I kept it to +2 and -20%, so it's easier for you guys to visualize. So as you can see, right, gold performance, when it actually swing both ways in high inflation environment. So what this suggests is gold's positive relationship over inflation is not as strong as what most people tend to assume, right? In other words, gold is not the most ideal inflation protection against inflation based on historical data. Now, if these are not the most important thing, right, what is, right? How, I mean, what would you want to use gold for? Yes, the gold is actually, there's one very important benefit of having exposure to gold in your portfolio, which is to use gold as a portfolio diversifier. Now, over a 30-year period, right, from 1993 to 2022, gold actually had exhibited a low correlation to major stock market. So what do I mean? Remember, what do I mean by this? Remember when we measure correlation just now in previous chart when we discussed about Chinese currency, we use a measure of R. If R is closer to 1, means that they are positively correlated, which means that if something goes up, the other thing will also go up. If it's closer to -1, then A goes down, B will also goes down. Okay, so what you can see over here in this chart on your right is gold correlation with the major market, equity market, right? Which is things like the MSCI Japanese index, the S&P 500, the Russell 2000, the MSCI World Market, and so on, right? So as you can see, especially compared to S&P 500, which is second from the left, right? Gold is the correlation between gold and S&P 500 is almost close to 0. So what this means is essentially, right, they behave in their own different world, right? So you can imagine gold and S&P 500, they are a very different personality that do not have influence each other. So example, in the long run, S&P 500 might do something, but gold will not be influenced by it. So you can imagine if you have gold in your portfolio, when the stock market tanks, right, gold would be, because they don't have a correlation, gold would be a very good, excellent diversifier. So I would not be able to show you in how good it go as a portfolio diversifier without some of the historical data. So let's do some experiment over here, ladies and gentlemen. So imagine, right, let's look at this portfolio. On your left, right, there are 3 pie chart. Pie chart number 1 is a portfolio with 100% of US stocks. Number 2, the pie chart number 2 is a portfolio with 90% US stocks and 10% gold. And portfolio number 3 is a portfolio with 80% US stocks and 20% gold. Now, let's do an experiment, right? And let's simulate based on historical data. Assumption, we start at 1972 to December 2023, and with a starting capital of $500 and monthly contribution of $500. So if we do that, right, let's say we start with 500 and every month we invest $500 in 3 of this portfolio. How's the result like, right? So as you can see over here, the cumulative annual growth rate, which is the overall average yearly performance, right, of all 3 portfolio, the 100% stocks is 22.75%, 90% stocks and 10% gold is 22.57%, and 80% stocks and 20% gold is 22.35%. So as you can see, the difference, yes, there are some difference, but the difference are minimal. But the benefit is of having gold in your portfolio is shown in the maximum drawdown. So maximum drawdown basically measures, right, how much of I would say the drop that you need to endure as during this whole investing period that we did, right, in this experiment. So the portfolio with 100% US stock experienced about 50.57% of maximum drawdown. On the other hand, the portfolio with 10% exposure to gold, right, has performed slightly experience about 44.83% of maximum drawdown, which is about 11% better. And on the other hand, gold with 20% of exposure for portfolio number 3 experienced about 38.74% of maximum drawdown, which is about 23% better. So imagine this maximum drawdown as if like when the market drops, right, the pinch that you feel, the pain that you feel, right, in your gut, in your emotion, right? Imagine if having about 10 to 20% of gold help reduce your pain or your damage to your emotions, right? By about 11 to 23% better. Helps you feel better when the market goes down. So this is one of the very key characteristic of having gold as a part of your portfolio, right? Which is to help reduce your max drawdown, while in the long run, keeping the return right about similar, although slightly smaller, right? Okay, so this basically today we have covered things like the China currency. We have covered some of the historical information about the China currency. We have also covered things like what are some of the strategies or things to consider if you want to invest or trade the FCNH futures and also FGLD futures. And also I also covered with some of the historical data to show you that gold is actually a fairly stable. It's not as stable as most people tend to think, and it's not the best hedge against inflation, right? So let's recap what we have learned today before we move on to the Q&A session. Number one, China has been faced with a sluggish economy and deflationary pressure in 2023. So as you can see, price have been dropping, and people in China, they are expecting a further, because people in China, they are expecting price to fall further. So they tend to delay their spending as such, right? They have been in a very tricky cycle, right, where people don't spend and price continues to drop just because people don't spend. So they are in a very tricky loop that needs to be addressed by the Chinese government. And when you want, as such, right, for those of you who are investors or traders in FCNH or the China market this year, consider how the Chinese government handle deflation, right? Especially look at how their inflation numbers are like, right, for the next few months, and see if they manage to push it further back to positive. And not only that, you want to see if US interest rate, how Fed deal with the US interest rate this year. Where are they going to raise interest rate again, despite the chances are small? But the key here is when are they going to cut interest rate, right? So these are some of the key things that you need to note while trading the FCNH in 2024. Now, meanwhile, we also look at gold, right? It's not the best hedge against inflation. It's not the most stable asset. Then what does it do? It is gold, based on what we have learned today, it is a very effective portfolio diversifier to help you lower your overall drawdown in the long run as a investor or trader in the market. Now, finally, if you want, after today's session, you want to gain exposure in the market, in the Chinese currency and also gold, please definitely consider checking out FCNH and FGLD. That is futures through the Bursa Malaysia derivatives or BMD. So I hope you guys find this useful, and this is my sharing about FCNH and FGLD futures. So I would like to pass the stage back to CY.